history doesn't just repeat itself. It evolves, adapts, and returns in ways that feel completely new, until it's too late. And in the stock market, that illusion becomes even more dangerous, because every generation of investors ends up believing the same thing. Now here's the point investors should think about carefully. John Templeton, one of the most successful investors in history, once called those 4 words the most expensive words in the English language. Because those words don't just describe optimism, they justify it. They allow investors to ignore risk, overlook warning signs, and convince themselves that the rules no longer apply. And once that mindset takes over, even smart investors start making very expensive mistakes. And if you want a real example, consider Jesse Livermore, a trader who made and lost fortunes several times. He once said, "There is nothing new in Wall Street. Whatever happens today has happened before and will happen again." That might sound simple, but it's uncomfortable, because it means no matter how much technology evolves, no matter how advanced markets become, human behavior doesn't change. And that's where this story begins. Most people know about the dot-com bubble or the 2008 financial crisis. But there's another bubble that doesn't get nearly enough attention, yet it might be one of the most important warnings for today's investors. Because when it burst, the damage was brutal. The market dropped nearly 50%. Some of the strongest companies in the world lost 60%, 70%, even 90% of their value. Inflation surged into double digits. And the recovery didn't come quickly. It took nearly a decade. Think about that. Years of waiting. How? Just to break even. And the most surprising part? It all started during a time when everything felt perfect. The late 1960s in the United States were filled with confidence. The economy had been expanding for decades. Businesses were growing. Innovation was moving fast. People felt safe. And when people feel that way, something dangerous happens. They stop questioning risk. Instead, they start believing in certainty. From the end of World War II to around 1970, the stock market had already delivered over 300% growth. Proof that the market worked. Proof that growth would continue. Proof that investing had become predictable. And out of that confidence came an idea that sounded completely reasonable. What if there were companies so powerful, so dominant, that you never needed to question investing in them? What if there were stocks you could buy, and never sell? This idea became known as one-decision investing. And the companies behind it became legendary. These weren't risky startups. These were giants, household names deeply embedded into everyday life. Businesses people trusted without hesitation. Investors didn't just believe in their growth. They believed in their certainty. And once that belief spreads across the market, something dangerous begins to form. Because when enough people agree that something is guaranteed to succeed, they stop questioning the price. And that's exactly where the real problem begins. By the early 1970s, these companies weren't just popular, they were extremely expensive. Not because their businesses suddenly became magical, but because investors stopped caring about valuation. They weren't buying value anymore, they were buying comfort. At the time, the overall market traded at a price-to-earnings ratio of around 15. That's normal, healthy, sustainable. But these untouchable companies? They were trading at 40, 50, even 80 times earnings. Now think about that. Investors were willing to pay extreme prices, not because the numbers made sense, but because the story felt too good to question. And this wasn't a small trend. A huge portion of market money flowed into just a handful of companies. Investors believed they were diversified, but in reality, they were heavily exposed to the same risk. So let me ask you, if most of your money depends on a small group of companies staying strong, is that safety? Or just hidden risk? Because history already answered that question. And the answer wasn't pleasant. Here's the truth most investors learn too late. Great companies are not always great investments. Because the market doesn't just reward quality, it reacts to expectations. And when expectations become unrealistic, even the best companies can deliver terrible results. That's exactly what happened. In the early 1970s, economic pressure started building. Inflation rose, oil prices surged, unemployment rose. The economic picture shifted, and when conditions shift, markets respond. But here's the critical part. Unemployment increased, the environment changed, and when the environment changes, markets react. But here's the critical part. Overvalued stocks don't fall slowly, they collapse. Between 1973 and 1974, the market dropped nearly 50%, and the companies investors trusted the most didn't hold up the way they expected. Some of the biggest names lost over half their value. Others dropped 70%. Some collapsed more than 90%. And this is where the illusion completely breaks. Because these weren't bad companies. They didn't suddenly stop operating. They didn't disappear overnight. But their stock prices still crashed. Why? Because investors had paid too much. And once that realization hit the market, there was no escape. But the real damage wasn't just financial. It was psychological. Because when you believe something is guaranteed to succeed, and then it doesn't, the impact is much deeper. Confidence turns into confusion. Confusion turns into doubt. And doubt eventually turns into regret. Investors who once felt certain suddenly found themselves questioning everything. And worst of all, they couldn't just walk away. Because by the time most people realized what was happening, it was already too late. And instead of a quick recovery, what followed was something much harder. Time. Nearly 8 years passed before the market fully recovered. 8 years of waiting, hoping, watching with no real progress. And for many investors, that experience changed the way they saw the market forever. Because they learned something the hard way, price always matters, no matter how strong the story feels. Now here's where things get uncomfortable. Because if you look at today's market, you might feel a sense of déjà vu. Mark Twain once said, "History doesn't repeat itself, but it rhymes." And right now, it's rhyming loudly. Today's market has its own version of one-decision companies, a small group of tech giants dominating industries and attracting massive investment. Companies like Apple, Microsoft, Amazon, Google, Tesla, Nvidia, and Meta. Individually, they are incredibly strong. But together, they represent a huge portion of the entire market. Which means something important. When you invest in the market today, especially through index funds, you're not as diversified as you think. You're making a concentrated bet. And just like before, the story feels familiar. These companies are dominant. They're innovative. They're essential. And because of that, many investors believe they can only go up. But investors in the past believed the exact same thing about the leaders of their time. Until they didn't. Now to be clear, today's companies are not identical to those in the past. The world is different. Technology is more advanced. But human behavior? That hasn't changed at all. People still chase performance. People still ignore risk when confidence is high. And investors still persuade themselves that tomorrow will look exactly like yesterday. Even Warren Buffett warned about this mindset. He said, "What we learn from history is that people don't learn from history." And that might be the most important takeaway. Because the biggest risk in investing isn't always the economy. It's not just inflation. It's not even market crashes. It's belief. The belief that success will continue simply because it has in the past. The belief that strong companies guarantee strong returns. The belief that price no longer matters. And every time that belief takes over, the outcome has always been the same. Eventually, reality steps in. So the real question isn't whether the market will crash tomorrow. The real question is whether investors today are repeating the same pattern, ignoring valuation, concentrating risk, and quietly believing those 4 expensive words. This time it's different. And if you made it this far, make sure you subscribe, because here we break down complex financial ideas in a way that actually helps you think smarter, avoid common mistakes, and stay ahead of the crowd.